take the profit and make some adjustment to this profit, and this is why the method is known as the indirect method. Now, in the indirect method, we are basing all the calculations in converting the net profit from an accrual-based accounting measure to a cash accounting measure. So in order to convert or in order to adjust the net profit into a measure that is based on cash accounting, we need to filter, we need to take out all the effects and impact of the accrual accounting into this measure, into this indicator. So basically what the indirect method does is that it is based in an already prepared and calculated figure, like the net profit or the profit from before interest and taxation, EBIT, and then alter and adjust this measure in order to take out the effects of the accrual accounting and being converted thus in a measure being measured based on the cash accounting. That is that we take as a starting point basically the profit or loss before taxes. Now this is what the standard really suggests, which is the result to be based upon. It is the profit before taxes. Of course, it could very well be a loss before taxes. To the profit before taxes, we make basically two kinds of adjustments. The first kind of adjustment is for the non-monetary items. That is every expenditure or every income that has a non-cash basis. It is non-monetary. It should be exempted. It should be compensated. And the common items of non-monetary expenses and income are listed over there. When you usually hear this item, you know that you should adjust the profit before taxes with these amounts. For example, you can see the depreciation expenditure. And we already have discussed that depreciation does not involve cash. This means that when you say we have depreciated the machinery by 2,000 euro, this does not mean that you are paying 2,000 euro. Of course, you are going to include that as an expenditure, but in order to take out the negative effect, you have to add it back in order to compensate, in order to net off the negative effect of this expense, which is a non-monetary one. The same thing I would say about provisions. Whenever you provide for something, for example, provision for bad debts, for trade receivables that probably you are not going to collect, you are not actually paying any money. You are recognizing an expenditure following the rules of accounting, of prudence accounting, of course, and so you provide for the foreseeable expenses in the future. But when you recognize the provision, actually you are not paying anything. By deducting the expenses for provision, you are not actually paying, and in order to convert the profit into a cash basis measure, you need to add back this provision. So it has been previously deducted, now you add it back and it is compensated, it is netted off. The result or the effect is being annulled. The same thing I would say about deferred taxation, unrealized foreign currency gains and losses, and undistributed profits to associates. Something not listed here, but that we mentioned yesterday, it is loss or gain on fixed assets. Loss or gain on fixed assets is the same kind of stuff. It is non-monetary expenditure or income, and therefore they should all be included in the first type of adjustments that I need to do to the profit before taxes. Again, what is our intention? We need to convert profit before taxes from an accrual-based accounting measure to a cash-based accounting measure. And that is, we have to take out all the effects that are brought in this indicator by the accrual accounting, which is the first thing to do. Consider all the items that are non-monetary. Take them out. How can we take them out? By doing the opposite, what we have previously done. An expenditure has been deducted, add it back to take it out. A previous income has been added, but actually we are not receiving any money for that. Deduct in this moment, take it out. So we are going also to see in our example, but remember that the first thing that you need to do is to take out all the non-monetary items, being those expenditures like depreciation, provision, loss on fixed assets, or also income like gain on sale of fixed assets and unrealized foreign currency gains. The second thing to do to adjust the profit and to have a cash basis indicator is to reflect on the changes that have been happened in the working capital items. Usually what we mean by working capital items are trade receivables, trade payables, and inventories. These three items you can find in the balance sheet, in the current sections of the balance sheet. More specifically, the trade receivables and inventories you can find under the section of current assets, whereas trade payables are to be found under the section of the current liabilities. Whatever has happened in these three items from the beginning to the end of the period may reflect a non-cash adjustment. That means that probably you have purchased inventory and the inventory has been increased very well. You have spent money to increase the inventory, but we have not sold it yet. Therefore, the effect of the increase in inventory is not in the profit. You can adjust the profit as much as you want, but you have some cash effects that are not reflected in the profit itself. So the first adjustment tries to adjust the profit from the effects that it has been included in this indicator, whereas the second adjustment relates not to the profit in the income statement, but goes to the balance sheet and looks at items that probably have been involved in cash inflows and outflows, but have not been reflected or realized in the profit amount yet, if you know what I mean. Now, I want to clarify something. Usually in accounting and financial reporting, the first statement to reflect the changes is the statement of financial position, is the balance sheet. Whenever you do something, you purchase, you sell, whenever you invest something, whenever you take a financing of any kind, the first effect is not going to be the income statement. The first step of reflecting that transaction is the statement of financial position. And only after that, when this transaction has been realized, this is the term that we use in accounting, only when the transaction is realized, it will give its effect in the income statement. Let me take a very simple example. Remember when you purchase inventory? When you purchase inventory, that is not an expenditure, not yet. You purchase the inventory and you reflect this transaction in the statement of financial position. The inventory is to be found there. It is only when you sell the inventory that the effect of this transaction will pass through income statement and profit and loss. Do you get it, like what I'm saying? So anytime you do something in a company, the first thing to reflect the effects of that transaction is the statement of financial position. Like in case when you purchase inventory, you are purchasing inventory, but that does not mean that you are doing an expenditure, not yet. You are doing an investment in inventory, if we can call that investment. It is a short term, but you are investing in purchasing inventory. And as long as you have that inventory in your warehouse, it is something that is going to be shown and disclosed in the statement of financial position. Only when the inventory is going to be sold and delivered to the customers, it is only then that you are going to recognize the effects of this transaction in the income statement, in the item of cost of goods sold. Now this means that when I try to adjust the profit figure in the income statement, still I am missing many transactions that have been happening but are still in the statement of financial position over here. They are not yet in the income statement. So as much as I can try to adjust the profit figure, I'm not reflecting everything that has happened in the company. I need to go back in the second adjustment. I need to go back to the statement of financial position and look at that and see what may have involved paying or receiving cash over here. That is not yet in the profit, but still it has caused the amount of cash to be changed. And the most common items are trade receivables, trade payables, and inventory. Like for example, the previous example of inventory that I brought to you, if you purchase inventory, you are paying cash. So you are affecting the cash position, and this should be included in the cash flow statement. But if you are only purchasing inventory without selling that, this is not going to be reflected in the income statement. So as much as you try to adjust the net profit figure, nothing is included there reflecting the purchase of inventory in cash. So I'm just trying to argue why is it necessary to do the two kinds of adjustment. The first one takes the profit before taxes and delivers this amount from all the effects of non-monetary expenditure or income. And then after I do that, I go back to the statement of financial position, I check trade receivables, trade payables, inventory, and also other operating current items, like for example taxes payable or salaries payable. They may even be in the balance sheet and they reflect something that has to do with cash, but they are not part of the income statement. I have to reflect these adjustments, the difference between opening balance and closing balance, in the cash flow statement. Is that clear to understand for everybody? Now, of course, this is just something theoretical, what we need to do. Practically, we will see at the example that we started to solve yesterday. There is a third kind of adjustment, but actually this is very simple to comprehend. All other items for which the cash effects are investing or financing cash flows. That means that sometimes in the profit figure, profit before taxes, I may have included an income that it is not operating in its nature, so I need to reclassify this income or expenditure, which is actually investing or financing, not operating. I need to reclassify in another category, in another class. So this is a basic adjustment, like we will see. If you remember from yesterday, we had rent income related to investment properties. And rent income actually was classified as investing and not operating, therefore I need to just reclassify. This is the third kind of adjustments over here. But remember, the two basic adjustments that you need always to remember and apply are the first one to the profit before taxes, to take out all the non-monetary items, and the second one jumps to the statement of financial position. Watch very carefully the section of current assets and current liabilities. What is operating under the sections and what is changing should be reflected in the section of operating activities in the cash flow statements. Now, more specifically, what are the adjustments that we need to make? And this should be, let's say, this should be used like a common step or chronology that you can follow while you prepare the cash flow statement. What is the first step? This one. What is the second step? The other one. So you can follow this like a kind of guidance during the preparation of cash flow statement. So we start with profit before taxes. Where do we find profit before taxes? It is very easily to be found in the income statement. It is an item that we find by the bottom of the income statement usually. Then we perform the first type of adjustments. The first type of adjustments relates to the non-monetary item. Remember, what do we do is that if we find or if we have any non-monetary expenditure, we will add it back in order to compensate or in order to take off their negative effect. For example, the depreciation. You have deducted the depreciation to arrive at the profit before taxes, okay? But by deducting the depreciation, you are not actually paying any money. So it's not fair to subtract or to take it out. Now we add it back just to compensate the effect or to reverse this negative effect of depreciation. So do not think that adding expenses plus non-monetary expenses, that's not okay. I know that it seems at first sight it's not okay, but think that we are not trying to add expenditure here. We are just trying to reverse their effects. We have previously deducted the expenditure at the profit before taxes figure, and now we are just trying to reverse their effect. The same thing we do with non-monetary income. We have included them in the profit before taxes, but that does not mean that we are receiving any money. And that is not okay. We have to reverse this effect. So we can just not have a positive amount that is not related to any cash income or cash inflow. For example, if we have gains from sale of fixed assets, these gains are already included in the profit before taxes. Have you received any money related to that gain? It's just an accounting regulation. No. And therefore you have to minus it right now in order to reverse this not acceptable, not usual effect. So just think and try to memorize maybe that the first kind of adjustments in the indirect method involves the non-monetary items, which are already included in profit before taxes, but without generating any cash. I have to reverse them all: depreciation, provision, loss or gains on sales of fixed assets or currency. They are not generating cash. Just reverse them by doing the contrary you have previously done. Add back the expenses, deduct the income. After you finish with the first kind of adjustments, you are having an item which in the cash flow statement is recognized as operating profit before working capital changes. Maybe this is a long name. I don't want you to memorize that. I just want you to understand what the adjustments are to be made, okay? So the operating profit needs to be adjusted for the working capital items. Again, working capital means payables, receivables, inventory, basically, but also items like taxes, salaries, rent payable or prepaid, in case we have them. That is common items that are related to the operating activities. That is the working capital. Usually, if we have an increase in current operating assets, we subtract that increase. That is why you find a minus sign over there. Current operating assets we can recognize by this abbreviation over here. Why should we, or why is it necessary to deduct the increase in current operating assets? Can you mention to me just any item of a current operating asset? Just mention one and I will give you an example. Which may be a common item in current operating assets? Just one.
Asset held for sale.
Sorry?
Asset held for sale.
Assets held for sale.
Yeah.
Okay, I'll go with that. I would have chosen inventory or trade receivables, but I'll go with that. Assets held for sale, and we have a suggestion: raw materials. Yes, Alessandro, it can be inventory as well. Thank you. I'm taking assets held for sale. It is a current operating assets. If we are increasing these assets from one period to the other, or from the beginning to the end of the period, if we increase the assets, mean that we have paid in order to receive more assets, right? In case we pay, this means that we have less money, and therefore we have the minus sign over there. This means that if you notice an increase in the assets held for sale, this means that actually you have used cash to increase the assets. They are not increased by themselves, okay? They are increased only if you pay something to purchase them. And this is why there is a minus sign over there. On the other hand, if you have a decrease in an item of current operating assets, that's a plus for you, for the cash of the company. Now, I'm taking the example Alessandro was suggesting, raw material. If you are decreasing raw materials, this means that you have used them in production, and probably you have sold the finished goods. When you sell the finished products that you manufactured using or decreasing raw material, this means that you have been providing more cash for the company. So whenever you see that you have an increase in an operating asset item, that means that probably you have used money or cash to increase that item. And whenever you see a decrease in any operating asset item, that means that probably you have been receiving cash in instead of this item, or for selling it out, or disposing that item. Okay, that is the logic after these signs that you find there. At first you may think, why minus, why plus, what's the meaning of that? Just try to think what is the effect that an increase or a decrease may cause to the cash state, to the cash balance of the company. So let's continue with current operating liabilities. You can see there that if we have an increase in a current operating liability, it should be added, is a plus sign. This means that it has a positive effect on the cash balance of the company. Mention a random current operating liability item. Payables. Okay. If you increase the payables, trade payables to your suppliers, what does that mean for the company? Of course, not for you. If the payables are increased, this means that you have not paid the suppliers. You are taking or you are keeping the money for yourself. So the cash is in the company, therefore you have the plus sign there. So whenever you have an increase in the liability, this means that you are not paying these liabilities. You are not liquidating the suppliers or the salaries, employees, and so on. That means more cash for the company. Instead, if you notice that you have a decrease in the liabilities, this means that most probably you have used cash to pay off the liabilities. At least I don't know of any other method of decreasing liabilities. We just have to pay them. Salaries, employees, banks, the state, the suppliers, we decrease the liability toward these third parties only if we pay them. That is why whenever you notice a decrease in an item of current operating liabilities, that should be with a minus over there. Again, I emphasize and I strongly encourage you not to memorize these signs by heart, plus, minus. Just think what something may cause to the cash balance of the company. If I have an increase in an asset, that means that most probably I should have used money to increase my resources, which are the assets. If I have a decrease in the resources, in the assets, probably this means that money has flowed in the company, and therefore there is a plus sign. Whereas for liabilities, if we have an increase in liabilities, this means that I have not used money to pay these liabilities, more money for me. That is the meaning of plus sign over here. Whereas if we have a decrease in liabilities, this means that most probably I have used money to pay off the liabilities. So this is the meaning of the minus sign. Again, I strongly encourage to think and to logically think about the signs, not just memorize them, pluses and minus, because what we are doing or what we are trying to do here is to understand the effect of transactions. Of course, the cash flow statement is being prepared by the accounting software. You are not going to do that when you work, but you should be aware of the meaning of the changes in the items. What do they cause to the cash balance of the company? That's why I'm encouraging and really pushing you to think about the meaning of the signs, plus and minus is over there, okay? Any questions so far? After we carefully go through the current assets and current liability sections in the balance sheet and see if any item has changed, and if they have changed, increase or decrease, we put in this section with the proper signs that we have explained here, we can calculate what is known as cash generated from operations. Be careful, it's not still CFO, cash flow from operations. This is what I'm trying to calculate here in the first section of cash flow statement. Cash flows from operation is different from the cash generated from operations because we still have to reflect two things. We deduct interest paid and also taxes paid. Now, both of these items may have some other places where to be included. We mentioned yesterday that, for example, many companies may choose to include interest paid under the financing section. So if you don't find any interest paid over there, don't be surprised. Check on the financing activities and it will be included in that third section. Whereas the taxes paid also, the company is advised to include in the operating activities most of the time, But if they judge that they are connected more with investing or financing activities, maybe you don't find them there. What I'm trying to say is that it should be pretty easy at this point, once you have calculated cash generated from operations, it should be pretty easy to include the last two items. How much interest did you pay? How much taxes did you pay? That should be, at least at this point, pretty easy. Okay, this was something theoretical about the indirect method. I would like to jump at the exercise that we were looking at yesterday. This is the exact state of the exercise that we left with. Okay. I think that I left like a homework to calculate the purchase of the property, plant, and equipment. Any of you has calculated the purchase of PPEs? Do you need to go through the data again, or do you remember the situation? Any idea of how to calculate the purchases of the PPE? Any of you has tried? Really? Even if you failed, it's important to start at least trying, right? We have this kind of, let's say, equation over here, so we can apply this kind of equation to calculate the amount of purchases of PPE. Yes?
We have to add 1.4 million.
Which is?
A new investment property.
Reclassifications, right?
No, for the 1.6 million, sorry.
Okay, and then?
And then we have to depreciate for 1.5 million.
Okay, I'm first of all, reclassifications. Again, I'm following this kind of equation here. We start from the opening balance of the property, plant, and equipment. Okay, yesterday we discussed with one of your friends with T accounts, but I think that you are not interested in T accounts now. Opening balance of property, plant, and equipment is actually right here, 25,200. We add the reclassifications. Okay? So how much are these reclassifications? You said they are 1.6 million. So in thousands it should be this amount over here. This is going to be included in the value of property, plant, and equipment. We also add what? If we have increases in fair value, this was a year in which the property, plant, and equipment was not increasing, but was decreasing, we mentioned, right? So in 1 year you cannot have both. You either increase the fair value of the property or you decrease them. They cannot happen both things in the same year. So just for the sake of keeping the equation, I'm writing here increases in fair value, but I'm just saying over here it is 0. Why? Because this was a year in which we have a decrease. Where did we see that we have a decrease in fair value? Again, mention or remember what we said yesterday. Notice the decrease in revaluation reserve, which reflects the changes in the fair value of the property, plant, and equipment. And also, if you are not convinced by that, see the income statement, other comprehensive income, minus 1,300. This is again the decrease in the fair value, the same thing. Okay, so let's continue. Now we have also to add purchases of property, plant, and equipment. And this is the X amount. In an equation, this is the unknown amount that I need to calculate, okay? So let's deduct. What do we deduct over here? What are the amounts that should be deducted? Let's start with depreciation. What is the depreciation amount for this year? Okay, so 1.5 million, in thousands 1,500. Also, we deduct decreases if we have decrease in fair value, and actually we have a decrease in fair value, 1,300, right? So we deduct over here. Something else that may cause the reducement of the amount of the property, plant, and equipment, they are depreciated, their fair value will be decreased, and something else is that I may sell some of them, and actually this has happened. PPE sold during the year, and their carrying value, so the value that they have in our accounting books in the moment of disposal, it is said to be, let's go to the data, 2.3 million, okay? So the reduction from the PPE sold, it is 2.3 million. Now, if I start with opening balance of the property, plant, and equipment, if I add all the three possible things that may cause the increase in their amount, and I deduct all the possible things that may decrease their amount, I should be left with the closing balance of the property, plant, and equipment, and this closing balance is right here, 26,700, okay? Now this can be converted in a simple mathematical equation where we can find x as the unknown figure, okay? So 25,200 plus 1,600 plus the x, the unknown amount, that should be equal with 1,500, 1,300, 2,300 plus 26,700. If we make all the necessary calculations to calculate everything that is missing here, you will find that the purchase in property, plant, and equipment is 5,000 euro. None of you could actually calculate that, or you didn't even try? No, you didn't try, or you couldn't?
Mistaken.
Okay,
Mistaken.
I see. Now, do you get where you were on? Do you need me to repeat what we said or how we did that? Okay. Okay, we have a request to repeat. So what we are trying to calculate is this amount over here that we don't know. Purchases of property, plant, and equipment. Remember that we said that normally not only property, plant, and equipment, but all the accounts in accounting, all the items, usually they have this common equation over here that I'm repeating. Just let me take this out because they confuse us. Usually everything will be equal. Forget accounting. Usually everything in life will be equal with what you find at the beginning plus what you get in, less what you go out, and what you are left with at the end of the period. Or take the beginning of the day. You have some money in your pockets. You take some money in from your income, whatever. Then you pay something for food or for something during the day, and you have the balance at the end of the day, right? So this is something that happens with everything. And now we are saying that this happens also with properties. What we find at the beginning of the year, plus what we increase our properties with, less the decreases from probable causes or things, should be equal with what we find in our property at the end of the year. Now, what causes the increases of the property, plant, and equipment? And what causes the decreases of them? Usually the property increases because of purchases of new machineries, from increasing their fair value, so I'm not buying anything new, but what I have values or is worth more than before. This is the increase in fair value. And another thing is that we may reclassify something that I've been using in my plants in Singapore, I'm now taking in Italy. This is a reclassification, so it's worth more here, okay? Whereas the decreases in property may usually happen due to these three reasons. First of all, they are being depreciated. So I'm calculating depreciation over the years. And this is the most common reason. The second thing is that the fair value has been decreased. That is that I'm not selling anything of what I have, but what I have is worth less because of the reduction in prices in the overall market. This is the decrease in fair value. And the last thing is, if I sell any existing machinery, I will have less of them, okay? So basically what we are doing over here is that we start with what we have in the beginning in the property. We add every possible thing that may have resulted in an increase in the property. What has happened during the year for this company, for this data that we have, for this information that we are provided with. We have some reclassifications. Assume that we are taking some machinery from abroad into Italy, so we have been increasing the amount and the value of the property. Do we have an increase in fair value? We said no, but still, for the sake of representing, we are putting 0 there. Do we have purchases of PPE? We don't know yet, but let's assume we have, and we are just putting that with an X. We don't know the amount of the purchases for the moment, right? Depreciation, then we take into consideration the possible causes of reduction in the value, which are the depreciation amount. We have depreciated the properties with 1,500, yes. We have a further decrease in the fair value with 1,300. Again, this is all information in the financial statements. I'm not making up any of them. But also I have to consider the third cause, plausible cause, that may bring the reduction in the value of properties, and that is, have I sold any of them? Actually, have I been disposing any of existing machinery? Many companies do that, actually. They currently or constantly, they replace old technology with new technology. So they buy new equipment, they sell existing equipment. And therefore we have the property sold 2,300. We know that the closing balance is 26,700. Now how do we calculate the missing figure over here? I know that the sum of these three figures should be equal with the sum of all of this here. So it's 31,800 if we make the calculation, less 1,006, less 25,200. Okay. Less. Okay. Is that more clear now? Okay. Any questions? We have a lot of calculations like that to do actually during the preparation of cash flow statements. It's not only the property, plant and equipment to be accounted for, how it has changed, but also there are other items that we have to take into account. So be prepared to have a lot like this. What is the beginning of balance? What happened during the year? Did it increase? Did it decrease? And for what reason? Read carefully through the information, reflect everything in the equation over there and find the missing amount, find the missing link. Usually, always, it should be true what we are saying here. Opening balance plus increases less decreases is equal to the closing balance for everything, for property, for inventory, for trade payables, for trade receivables. This is always true for everything, and not only in accounting, but for everything. In finance, in everyday life as well, okay? Good. We have also calculated the dividends yesterday. Do we need to go through that again? No. Questions? Are we ready to try starting the preparation of the indirect method cash flow statement? Okay. So we first start to prepare the cash flow statement. The first thing that I propose you to do is fairly simple. Lay out the sections of the cash flow statement. Cash flows from operating, cash flows from investing, from financing. And then, as you go through information, find where it belongs. Does it belong to operating, investing, or financing? That is something that I think it's easy to do. So we start with cash flows from operations. We leave many rows blank because usually this is a very long section of the cash flow statement. Then we lay out the second section, cash flows from investing. That is CFI over here. Cash flows from operations. That is CFOs. And again, the last section is cash flows from financing, CFFs. So everything should be fitted somewhere in there. Now remember once again that scheme that we delivered through PowerPoint before. Usually for the indirect method over here, usually I am expected to start the calculation of the cash flows from operations from the profit before taxes. This is the starting point, remember? So profit before taxes, and then we make those adjustments that were suggested. But let's see how much the profit before taxes is. I'm working with formulas, so whenever I have an item already in financial statements, I'm just copying that. Profit before taxes, go over here. You see profit for the year, the line in the income statement that says profit for the year. This is profit before taxes, I apologize, is over here. It's exactly the amount where we start our calculation. So profit before taxes. Now actually, if you remember, we need to account only for those items that are reflecting the operating activities. And if you remember, relating the interest paid, I'm just putting them down at the end of this section. Interest paid and taxes paid, they were like the very last things to include in the cash flow statement. Now, as I need to add the interest and the taxes at the end of this section, I have to carefully think if this item profit before taxes in the income statement, does it include any of the taxes or anything that we are trying to take into consideration later? Now you see that profit before taxes is not including the taxes. Taxes are over here, are below the profit, right? But the problem is that profit before taxes already includes the interest expenses. You see there? We have deducted the interest expense to arrive at profit before taxes. But if I need to take in consideration the interest paid over here at the bottom, starting from an amount that already has the interest expenses included, it means to double their effect. So what I need to do now is to reverse the effect of the interest at this point. Why? Because the standard requires me to add the interest paid over here at the bottom. So this means that I have to add back plus interest expenses with 600 to have what we know as earnings before interest and taxes. Have you ever heard before this EBIT item, earning before? Okay, this is very famous. Now, I don't know why the standard doesn't really start from EBIT, but actually starts from profit before taxes, then you have to add back the interest expenditure. I may have an answer for that. Sometimes if you check the financial statements of the companies, especially where you are working for or for the projects, group works, you will find that sometimes companies do not have only interest expenditure, but they also may have interest income and also other financial costs like changes in currency or conversion rates. And that becomes complicated. To start from EBIT becomes really complicated because EBIT is before all of this that I'm mentioning. Interest income, interest expenses, currency rates, and so on. So maybe it's easier if we start with profit before taxes, and then we add back the interest expenditure because this last item will be included at the end. Okay, any question from those that are following us? So we are adding interest expenses. Why? Because remember, we have to take them into consideration later over here. So we start with EBIT, the amount or the sum between profit before taxes plus interest expenditure. Something else that I need to do, look carefully over here. Something else that we need to do before starting to prepare the operation section of the cash flow statement is if there is any of the income or expenditure over here that has nothing to do with the operating activities. Something should really attract your attention over here. Remember the rentals received that we mentioned before? Rentals received are included in the investing activities because they are coming from investment properties. That is, the profit before taxes, this 2,400 figure, includes an income which is basically not operating income, okay? Therefore, in the cash flow statement, I should include this 350,000 euro. I should include in the investing section. Therefore, in this moment where I'm talking about right now, the amount of 2,400 is including this amount which is actually not operating. What should I do now? Deduct this amount. So less rentals received because they are investing. I'm trying to give simple explanations in the brackets for you to read later. So why we deduct rentals received over here? Because they are considered as investing activities, okay? And they are not operating in their nature. Therefore, we deduct them. It is the convention, you remember the convention or the agreement that we did. Everything that represents an expenditure or a cash outflow, it will be with a minus. Most likely, in the majority of the times, the most common mistakes with cash flow statement is just a wrong sign, either a minus or a plus. If you correct that, you are okay, usually. So we first deduct rentals received, and we are ready to start with the first kind of adjustments. Adjustments for non-monetary items. So the first thing that we need to do right now is to adjust for those items that are non-monetary in their nature. Something that really jumps in my mind right now without even looking at anything, but based in what we discussed so far, and you can really say that, it is the depreciation. If you remember, we had some depreciation of the depreciation expenditure. You remember that we depreciated the property, plant, and equipment. The depreciation is the perfect example to illustrate for non-monetary expenditure. The depreciation has been deducted over here to arrive at the figure of profit before taxes, 2,400. Somebody of you may say, where is it? Where is the depreciation over here? Depreciation is part, if you remember the tutorial last afternoon about inventory. depreciation is part of conversion costs because it is fixed overhead. And usually, as it becomes part of conversion cost, is included here in the cost of sales. So this cost of goods sold is really a mix of very items, different items together. Direct material, direct labor, variable overheads, fixed overheads, electricity bills, depreciation, rent expenditure, maintenance fees, and so on. So depreciation is there, but not specifically mentioned. Why? Because the inventory standard requires us that what is part of cost of manufacturing the products should be included as fixed overheads or variable overheads, whatever they are, as part of cost of goods sold. But luckily, we should not really think, okay, what part of cost of sales is depreciation? It's okay. The data is readily here, provided for you. The depreciation of property, plant, and equipment is 1.5 million. So out of this 31 million over here, 1.5 is depreciation. We have included in cost of sales and we have deducted to arrive at the gross profit and profit before taxes as well. But that does not mean that we have paid anything. That means that in the indirect method, I will add the depreciation back, 1,500. So depreciation will be added to reverse its negative effect in the profit. This may seem maybe not necessary, but still I'm writing it so you can have as a reference for later, okay? It is added to reverse the negative effect that we are mentioning here. Anything else that should be adjusted? Any non-monetary item that I have to reflect here? The changes in fair value. What about the changes in fair value? What has happened with that? Mm-hmm. Your name, please?
Gloria.
Gloria. The changes in fair value, Gloria, which one?
Our investment properties.
Bravo. A big bonus for you, Gloria. Why? This is very important to understand. The changes in fair values for other property, plant, and equipment are over here. The red item over here. That means they are below the profit before taxes. Now I'm adjusting profit before taxes only for the items that are above that, okay? So everything that has not been included in profit before taxes doesn't affect what I'm doing right now. I should take into consideration only what's happening before, above that item. So I'm here, profit before taxes. Whatever happens below doesn't matter, I will take into consideration later. But right now I should be very attentive if before profit before taxes, all these items have anything non-monetary or anything that is not related to operating activities, I should be very attentive to that. I took out depreciation first, included in cost of sales, and also we took out rentals because they were not operating. Right now, it's the time of fair value changes. They are included with a minus in the profit before taxes. That means that I have deducted them and I have received a lower amount of profit before taxes, but actually I didn't pay anything. The 700,000 here, it's not paid. That means that I should reverse their negative effect because it's not representing a cash outflow from the cash balance or the bank account of the company. Therefore, I come here, the first adjustment is depreciation, a non-monetary expense. The second adjustment in the first category again is the fair value decrease in properties, investment properties. And this is 700. Again, why with a plus? It is included with a minus in this profit before taxes. If I add it back, we are not adding expenses. That is counterintuitive, I agree with you. We are adding back just to reverse the effect, okay? We are not adding expenses, that would be stupid enough. We are just adding to reverse the effect that is already here at the profit before taxes. Any questions so far? Now, anything that I may have missed? Any other thing that is non-monetary? There is one other thing. Yes.
I want to ask, like other comprehensive income, the decrease in PPE, so we didn't add it back?
No, because other comprehensive income are below profit before taxes. Okay? So their effect, which is negative by the way, again, is not part or is not included in profit before taxes. Remember that what I'm trying to do now, the intention of the first adjustments for non-monetary items, means that I will clear the profit before taxes from the effect of expenditure and income that have been included in this item but that are non-monetary. So again, the intention, the purpose of the first adjustment, which has this name, adjustments for non-monetary items, is that I will try to convert this item, profit before taxes, from an accrual-based measure into a cash accounting measure. How do I do that? But first I start with what is a non-monetary expenditure, I add it back. What is a non-monetary income, I will deduct that. Why? Because they have been included not correctly in this item. They have been included following the accrual accounting measures. I'm not following the accrual accounting. In the cash flow statement, we follow cash accounting. So again, what we are doing is that we are reflecting the non-monetary items that are currently already included in the profit before taxes. That is the reason why we, for the moment, we disregard this other comprehensive income. Don't even think about that. So just look above the profit before taxes. There is something there you may have missed. I'm insisting, there is a third non-monetary expense. Good. Usually, where do we include the loss of sale from fixed assets? Loss of sales from fixed asset usually is also part of the operating costs, and probably it will be part of cost of sales as well, but that does not matter in this point. What matters is that a third adjustment for non-monetary item, A was depreciation, B was the fair value decrease, and C is the loss on fixed asset. And the loss on fixed asset, if I'm not wrong, is 500. It is included in the gross profit already, but that does not mean that we have paid anything, right? Actually, we have received 1.8 million euro, and we have to put it somewhere. This loss is just an accounting adjustment of T accounts, not necessary to put you through that right now, but this is non-cash. Remember, loss or gain on sale of fixed assets are non-cash transactions. Whenever you read about them, you have to include in the indirect method under the category of the first adjustment for non-monetary items. Okay. Anything non-monetary for the moment? When we apply the adjustments of the first kind, of course there is an item of the cash flow statement over there, and it was that big item and title. It's not necessary to write that down. What is necessary and important to remember is to continue with the adjustments of the second type. The adjustments for working capital items. The second adjustment for working capital items takes us from the income statement to the statement of financial position. That means, be careful, whereas in the first kind of adjustment, my eyes, my attention were at the income statement, this area over here, before or above profit before taxes. Was there anything there that was non-monetary? And we identified three things. Now the attention with the second adjustment, the attention will be at the statement of financial position, basically the current assets section and the current liabilities section. We look carefully each item, don't skip any of that. And you think what has happened and what that means for the cash of the company. So let's take that one by one. So again, second adjustment for working capital items, we go with the statement of financial position, focus on two different sections, current assets and current liabilities. Are you tired? Do you need a break now or? Yes? Okay. In the meantime, 5 or 10 minutes break, look for yourself at the sections that I mentioned and see what you can do with those items. I'm putting in another color just for you to know that this will be our focus. Probably this inventory has been sold and we are receiving cash out of that. In the indirect method, we include decrease in inventory with a plus sign, 800. The next item that we see here is the trade receivables. Also a working capital item that affects the operating activities. We see a decrease in trade receivables. Most probably this means that the customers have liquidated their debt, they have paid their invoices to us, to the company. That means more money for the company, more cash inflows for the company. That means in the indirect method, we should again write plus decrease in trade receivables. If we focus on the values, it is 3,400 less 3,000. And the decrease in trade receivables, that means more cash inflows for the company, it is 400,000. Of course, the sums and amounts are in thousands. Be careful in this moment not to skip any of the items. We are taking them one by one. Inventory, the decrease was with a positive sign. The decrease in trade receivable also included with a positive sign. Now, what about the bank account? The difference in bank or cash and cash equivalents, remember, is going to be the final sum of the cash flow statement. So, whatever change happens in the bank account or the cash account, whatever the name is, you should find that this is consistent with the sum of cash flows from operations, investing, and financing. That means that in this moment, you should not think, not yet at all, you should not think about how the bank account has changed. We will think about that later because that is all the sum of the three sections of the cash flow statement. So we are done with the current assets sections. Let's continue with current liability section over here and let's try to analyze items with the same thought in our mind. Is there anything there that is operating and affects the operating activities? If it is operating and it has changed, it should be included in this place of the cash flow statement. First of all, we find something about trade payables. Trade payables are operating and they have been increasing from one year to the other. Applying the same logic, we would say that we have an increase in liabilities towards our suppliers. That means more money for the company, more money inflow or more money stays in the bank account in the company. So what we write over here is plus increase in trade liabilities. From the beginning to the end, it is 4,200 less 3,900. And we have a sum of 3,000. 100, let's check again. Yes, 300 increase. Again, the increase in liabilities, it represents a positive effect in the cash statement or cash balance, cash reserves for the company. Okay? The other line, the other item that we find here, okay, is part of current liabilities, but it is interest payable. Now the name over there, it is accrued finance costs, and that means very, very old. What is this? Simply, it is interest payable. Should I include interest payable at this place of the cash flow statement? And if not, which is the answer, why not? Why should we not include the interest, the change in the interest payable right now in the cash flow statement? Remember, we are looking for working capital item, that is, items in current assets and current liabilities that affect the operating activity. Well, obviously, interests are not operating. Interests, as we said, have a financing effect. So it's not in this place, it's not in this post of the cash flow statement that they should be included, okay? And to reinforce what I said, remember, a little bit later, we have this item over here, interest paid. This is the place where we should include that, okay? Let's continue, don't forget anything. What about the bank account over here? You remember we argued that this was an overdraft, but again we said that we are going to reflect the change in the bank and cash account. Okay, we are going to reflect the change in the bank and cash account as a total sum of all the statement, not in any specific section. And the last one that I have to mention is the current tax payable. Yes, it is operating, but it is not an adjustment for working capital. And as we said, the taxes paid should be reflected over here, as we mentioned. Now, if we also include the adjustments for working capital items, we should have what we know as cash generated from operations. And to cash generated from operations, we apply the interest paid and taxes paid. The cash generated from operations is obviously the sum between everything we have included so far. So plus interest, I'm starting from a bit. This is the sum of cash generated from operations. Again, it is not cash flow from operations because we need still to account for interest and taxes. These two lines over here are pretty specific because some companies may choose to include them in other sections, and that is the reason why usually you will find them at the very bottom part of the cash flows from operations sections, right below cash generated from operations. So we account and we take into consideration how much interest we have paid. Now remember that the interest expenditure is over here, it is 600. But did we pay actually 600, or we paid more, or we paid less? Remember yesterday we told several times, we talked over that sometimes the companies pay more than they spend, or pay less than they spend. Why? Because maybe they can pay for the future periods in advance, or maybe they can pay some expenses from past periods. So how we can understand if the company has actually paid 600 or more or less? Remember the difference. This is interest expenses, but in the cash flow statement, this is interest paid. They are not the same thing. At least sometimes they may not be the same amount. So how we check for that? Any idea? I mentioned something a couple of minutes ago. Look here, interest payable. This is a current liability and represents the...
We have to see the difference between the interest expense and
the difference between interest expenses and interest payable. Okay, sometimes it may be a difference, sometimes it may be a sum, but let's think together. What has happened with the liability here? It has been increased or decreased? At the beginning, I was owing to the banks 50. At the end of the period, I was owing to the banks 100, right? Has the liability been increased? Yes. Yes, that's easy. What does that mean? Does that mean if I increase the liability towards somebody else, a bank in this case, does that mean that I have paid them fully or more or less? Less. Why? Gloria, yes?
Because if I have if a liability increased, it means that I haven't paid.
Okay, so I have paid less than 600. Why? Because my liability is being increased. That means that from 600, which is the liability for the period, I've paid less than 600 because I am increasing the obligations towards this third party. Does anybody get that, or that is too complicated? I have another thing or another way I'm thinking to explain that, but if this is okay for you, I'll stay with that. If it's not enough, I will add something else. The more I say, the more I confuse you, I know. So I don't want to say many things. Something that you may use to calculate the interest paid, it is a formula, I'm just writing there, so you may have it, or maybe you can choose to ignore it and stay with what we said. Interest paid is equal with interest expenses plus opening balance interest payable less closing balance interest payable. Okay? Keep in mind that always you can calculate the payments with not only for interest, but for whatever thing, you can calculate the payments with this equation over there. You start with the interest expenditure or tax expenditure or salary expenditure, something like that in the income statement. Then you jump to the statement of financial position. You add the opening balance that reflects the liability for that item. In this case, we have interest payable plus opening balance, less closing balance of the same item in the statement of financial position. Okay, so if we apply this equation over here, that means that we have 600, the interest expenditure, plus opening balance was 50, if I remember correctly. The closing balance was 100. So again, interest expenditure plus what we owe at the beginning less what we owe at the end. And that is equal with 550. The way that your friend proposed to solve this situation, it may be easier to understand. I'm writing that there, is equal with interest expenses less increase in interest payable. And you arrive at the same balance. Interest expense is 600. The increase in interest payable is 50. 600 less 50, it will give you the same result. Try to memorize whatever is easier for you. I will not actually ask you to remember how calculated the interest paid. If you are able to combine the items together, that is the expense item from the income statement, with the related balances in the statement of financial position, usually interest payable or taxes payable or salaries payable and so on, you should be fine, okay? Any questions so far? You can check yourself if you understood that. Right here in the taxes paid, how much taxes did we pay after all? The taxes expense, income taxes expense over here is 600 again. But actually, did we pay 600 or we paid more than 600 or we even paid less than this amount? How are we sure about that? before saying something with certainty, are you okay? We jump again at the statement of financial position and we check that we have some current tax payable over here. And sometimes you also have to check because you may have deferred tax payable as well. So if you have current and deferred taxes, you should take them into consideration right now. This is the amount that you owe to pay to the government in form of taxes. For this period, your obligation is 600, but remember that you still have accumulated, I would say, obligation from previous periods, actually pretty high, 1,850. So maybe you have to pay for this year, and maybe you have to pay also for the previous years that you have not paid. Maybe sometimes governments put deadlines and you just have to pay, no way out. And actually you see that you have paid this amount because at the end of the period, you owe only 500. So your liability has been decreased. This means that you have paid more than just the expenses of this period. You have been paid also to decrease the accumulated and transferred and deferred, if you may ask that, tax liability to the government, okay? Again, how we calculate exactly in amounts, we follow the same equation. We start with tax expenses with the ITE that we have in the income statement. We add opening balance, tax payable, and we deduct closing balance, tax payable. You see there is a common way of calculating all these payments that we need to do. We start with the obligation for the year, that is the expenditure that we have recognized in the income statement for the year. We add the obligation at the beginning of the period, that is the opening balance of rent or tax or interest, whatever it is that. And then we deduct what is the obligation that we, by the end of the year, we still have not settled with this third party. Okay? We have a question in the chat. I would like to take that if you don't mind. We can understand we paid more. Yes, that is true. We can understand that we paid more than just the obligations of the period because we obviously have settled also some of the obligations from previous period. In simple words, that means what your friend is writing over there, the tax payable decreased. That's correct. So if we calculate, any question about the equation over here? Okay, so if we do the calculations, again, I go to profit and loss. This is the, income tax expenditure. We add the opening balance, and we deduct the closing balance. That is 750. 5,000, 700 and 5,000. Okay, something that I really forgot, but also you should have warned me. This is a common mistake. I told that many of you may do that, and I already did some kind of mistake. Remember that the most common mistake in cash flow statements is the signs. And related to the interest paid, I didn't put the minus sign before. So actually it is minus 550, not plus. This is paid. If I left it without a minus, it would mean an income, a cash inflow. Actually, interest paid are cash outflows. Also the same here when we make the formula, because we have used minus signs, we have to correct the formula again. So the taxes paid are 1,950. Again, simple sign problems with cash flow statement. Please be aware of that. Sometimes even I, because I'm trying to do it as fast as I can, all of us can go wrong with signs, but please check, double check, and you should be fine. Any questions so far? So we are finally able to calculate cash flows from operations, and that is equal with cash generated from operations less interest paid, less tax taxes paid, and CFO cash flow from operation is 4,350. And that is positive. That means that we have from cash flows from operations, we have income, we have received money. And if we start to interpret and analyze the statement, we would say that that is good for the companies. Usually companies expect to generate enough cash inflows from operations in order to support the investments and paying the financing. So I'm repeating again, this is important. When you calculate the cash flows from operations, usually you expect to find there a positive amount, and a pretty high positive amount. Why? Because usually companies generate cash inflows from operations and use this cash to support, one, new investments, so new machineries and plants that they purchase, and two, they use this cash to pay for or settle previous loans and bonds that they have issued. So we need this money from operations in order to support our other activities, investing and financing, okay? So after finishing the cash flow from operations, the rest should be pretty easy because, as we mentioned several times, the transactions involved in investing and financing are really very limited. Usually a company does not deal daily with buying or purchasing or disinvesting assets or issuing bonds or issuing shares. They happen really seldomly and really very rarely in a company. That is, the transactions that you put there are really very specific and limited and should be really simple by this stage. Why? Because previously we calculated almost everything that we need to put in there. Now remember what we put in the cash flows from investing activity. Theoretically, by definition, we put in this section everything that has happened and has impacted or changed the investment structure of the company. That means that if I have purchased property, plant and equipment, if I have dissolved or reduced and sold property, plant and equipment, if I have any income from these investments, I should include them right there. Do I have this stuff for our example? Actually, yes. We mentioned that we had purchases of PPE, we have PPE sold, and we also have some income from investment. Remember the rents that we receive from investment property? This is where they belong, this place over here, okay? So rent received from investment properties. Did we forget anything? So 1, 2, 3 transactions, we know that we are going to include them there. Did we forget anything? How can we be sure about that? Okay, just to make sure that we didn't forget anything. When you complete this part of the cash flow statement, always check the statement of financial position, the non-current assets section. Everything that is changing there should have an effect in the cash flow statement. So make sure that you are reflecting every change you see here in this section over here. Okay, let's go through that together. PPE has been increased. Okay, I will reflect the PPEs either sold or purchased, but also remember something else. Investment properties have been changed over here. And as they are changing, maybe I have purchased new investment property, probably, so I should reflect that as well. So please, when you complete the section of cash flows from investing, double check with the section of non-current assets in the statement of financial position. Everything that changes in this section here should be reflected in the cash flow from investing and cash flow statement. Now, what about the investment property? I'm not saying anything here for investment properties. Okay, I'm mentioning the rent received, but what about the change in investment properties? Let's go back to the information. So I will not, okay. You see here, the company acquired new investment property. So except for purchases of PPE, we also have purchases of investment properties. So again, what we are doing, we are making sure that we are including all the items that belong to investing activity. Include everything that may come to your mind about selling or purchasing new property, being that property, plant and equipment, investment, intangible assets, licenses, trademarks, and so on, and also any possible income from these investments that you may have. Make sure that you have incorporated everything by doing what? Go back at statement of financial position, not current assets. Double check there, have you included everything? Double check again the additional information that you are provided with, and make sure that you actually have included everything in this section. I think that we already included everything here. Please remind me, how much did we calculate the purchases of PPE? If I'm not wrong, they were 5,000, and I'm putting that with a minus because they represent a cash outflow. Now remember, if we didn't make the calculations of purchases over here, we would stop right now and make all that calculation in this moment. That's okay, you can either do at the beginning of the preparation of cash flow statement, or when the time comes, it should be something that you can do based on this equation. So purchases of PPE 5,000. What is the income? The income is not the right word. What is the cash inflow from selling existing property, plant, and equipment? Okay, look at here. Okay, there is a lot of information, but we are interested on how much money do we get in because of selling this property. And this is sold for 1.8 million. So PPE is sold. This is 1,800 cash inflow. And if it is cash inflow, then it will be with a plus on sign. Okay, rent received from investment properties. This is 350. Where do we find that? Here, 350. And also, now it may become clear why did we deduct the rentals received up here from the profit before taxes. Why? Because they belong at the investing activity. If we didn't reverse the effect of rentals received at the first section, you'd have a double effect right now, okay? And again, purchases of investment, purchases of investment properties, it is said that it is 1,400, according to this information over here, okay? What did I forget? Again, the signs. It's always a mistake that I'm very prone to do, but be careful as well. Sometimes you may do. Now we can calculate the cash flows from investing activities. This is the sum of these four items. And we can see that the cash flows from investing is with a minus 4,250. Now, is that normal? Do we usually expect investing activities to have more cash outflows than cash inflows? Actually, yes. For a normal company, we usually expect these normal big companies with a good activity in their markets. We expect from them to more purchase new machineries than sell existing ones. Actually, you would find it very, very suspicious one company that would declare a positive cash flow from investing. Write it down and look it very carefully in your work projects for your companies. If they declare positive cash flows from investing, that means that they are more having cash in from selling existing machineries than are paying to replace the technology. Such a company is clearly being liquidated and going out of the market, usually. Usually I expect to find positive cash flows from investing for those companies that are in the decline stage of life cycle. We know the stages of the life cycle of a company: introduction to the market, growth, maturity, and decline. Usually it is only at the decline stage, when the companies are liquidating and being took over by other companies, we usually find positive cash flows from investing. You really should be very careful if you find a positive amount over there. But in this case, it should be okay. Okay, a comment in the chat. If we have invested by buying trading security that are short term, I'm answering to the question in the chat right now. We mentioned yesterday that if the investments are in the money market, so trading security for less than 3 months, they are part of operating assets. But if these trading securities are for more than 3 months, obviously the purpose of the investment is to receive income in form of dividends or interest. And they should be in the investing section in the cash flow. So again, it depends on the purpose of doing that investment in the stock exchange. If you just buy shares or bonds in the money market, just to use the free cash flow that you are having for the moment, this means that this is part of operating assets. It is not your intention to earn for a long time. But in case you have invested for more than 3 months, it is clearly your intention or your purpose to earn in the form of the dividends or interest. So it depends, basically it depends on the term. If lower than 3 months, operating activity. If more than 3 months, it is investing activity. Okay, this was the second section of the cash flow statement. You saw that we concluded that pretty fast. It was easy. Now let's continue with the last section. It should also be easy, this one. In the cash flows from financing activities, we reflect every change, everything, every transaction that has affected usually the non-current liabilities and equity section in the balance sheet. That means that in this moment, there is a lot of information processing in my mind. Maybe we are tired at this point. Don't be confused. Go back to the statement of financial position and check equity and non-current liabilities. This section over here should represent everything that you need to reflect in the cash flows from financing and the cash flow statement. Now, has anything happened or any change in the equity shares? Any change in the equity shares over here? Yes, we have an increase in the equity. Usually, how does the equity increases? By magic? No. How do we increase the equity shares? Usually. We are the company always, okay? I'm talking to the first. Yes, by?
Issuing new shares.
Good. If I issue new shares, thank you for the answers in the chat. If I issue new shares, we have money coming in the company. That is, under the cash flows from financing, we should probably write here cash inflows from issuing new shares. Okay, so what are these cash inflows? Pretty easy to calculate. Usually the cash inflows from issuing new shares are just the difference between closing and opening balance. So the increase in the value of equity shares from the opening balance from the beginning of the period to the end of the period, 2,200, sorry. This is the cash inflows that we generate from issuing new shares, okay? Let's continue with other stuff over here. Revaluation reserve. Remember, the valuation reserve was reflecting what? The change in fair value? Good. Should I put it in there? I'm starting to write. Should I include it in there? It's part of the financing, why not?
Because it's not a monetary.
Good, brava. Big bonus for you as well. It is not a monetary transaction. Remember, cash flow statement only includes monetary. Hey, you should come here in the first place, because you always discuss with each other. So if you come here, I can control you better, not to discuss with each other, but to have more answers for the class. So we see a change in the revaluation reserve, of course, and they impact the statement of financial position, but it's a non-monetary transaction. It does not involve cash inflows or outflows. Why? We just see the fair value in the market. We increase the value of our properties, but that does not mean that I'm selling these properties now and I'm cashing in this difference. Probably that will never happen. That is the discussion that we did yesterday for realized and unrealized transactions that are taxed or untaxed. But in this moment, remember, this is not a realized transaction. We are not cashing in this increase or decrease, in this case, in fair value. We are not having any cash result. Something that is non-monetary should not be included here. So very easily we continue. What about retained earnings? We have a decrease in the retained earnings. Should I include that there?
Yes, dividends.
Okay, remember, we have paid some dividends, and yesterday we did all this discussion over here to show how we calculate the dividends paid. Because we have a decrease in the amount of accumulated earnings, and we also have 1,800 profit for the year that we do not find anywhere in the statement of financial position, we arrived at the conclusion that the dividends paid are actually 2,800. So this is where we put dividends paid. Be careful, it is a payment, so it should be with the minus 2,800, okay? So you see we are taking the items one by one and we are arguing, should we include in the cash flow from financing or not? That should be a consistent way for you not to get lost or get confused. Okay, the last thing that I should look over here, it is 12% loan notes. Now this is a long-term liability, but it has not changed. It has neither decreased nor increased. That means that I have not paid any part of this loan. I have not received more loans. That is no change to be included in the cash flow statement. If I had an increase in the loans, for example, just assume, don't write anything. If the loans would have been from 5,000 at the beginning, would have been increased in 6,000. That would have represented a cash inflow from having new loans, 1,000. So the difference would have been included in the cash flow statement. Also, if I had a decrease in the loan amount from 5,000 to 3,000, that means that I would have paid back the loan, and the decrease in this liability would have been included in cash flow statement as a repayment of loans, minus 2,000. But actually this did not happen, so we are in the starting position. Now, something very, very fast here. I told you that the cash flow from financing should really make you focus in this section of the statement of financial position, equity and non-current liabilities. But please, it doesn't hurt to have a look at the current liabilities as well, because sometimes hidden there you can have some items that have to do with the financing activities. For example, you may have an item like short-term loans or short-term maturity of long-term loans. All these items that I'm mentioning, they are part of current liabilities, but they have a financing nature. So you should include them in the cash flows from financing. Now, most probably, you might have encountered this item when you analyze current liabilities for the purpose of making the second kind of adjustments in the cash flows from operation. So probably you are aware that there is something in the current liabilities that I should take into account later. But please have a look before you continue. Now, we should be ready to complete all our endeavors, and I hope we are successful. So cash flows from financing is the sum between two transactions, and actually it is minus 600. Now, is that normal for normal companies, or is that suspicious? It should make me think about something. Actually, cash flows from financing is okay to be either positive or negative. It depends on the year, how the current year operations have actually been for the company. If the operations have been successful, I would have made enough money to pay back the existing loans and to pay enough dividends. For example, this is a year as such. Cash flows from financing are negative. This means that I have more paid out than cashed in, and that's okay because it's a good year. How do we know that? You see, cash flows from operations is okay, it's pretty high. It should be positive sometimes in those years when the company has had the need to take new loans or to issue new shares. If we take many new loans during a year, you will find that the cash flows from financing would be positive. Now, the sum between three sections is the net change of cash flows. The sum of the three sections is the net change of cash flows. Again, is the sum of cash flows from operations, cash flows from investing, and cash flows from financing. You see that the net change of cash flows during the year is negative. That means that from the beginning to the end of the period, the reserve of cash, the balance of cash, actually has been reduced. Overall, operating, investing, and financing, we've had more cash outflows than cash inflows. So the total net change is negative. That means that we have more paid out than cashed in. Now, there is a way to make sure that we are correct, right? We mentioned that yesterday. And this is the moment of truth. When you prepare the cash flow statement and you calculate the net change of cash flows, it should be equal with what? Who remembers this? Okay. It should be equal with the change, the net change of cash flows, that is the total of the cash flow statement, should be equal with the change of the cash or the bank account or the cash equivalent item from the beginning to the end of the period. What is this is wrong on my part, cash, not cash flows, but cash or bank or cash equivalent. Cash, bank, or cash equivalent, okay? Not cash flows, because that does not has any meaning at all. Cash at hand is not a cash flow. Okay, what is cash at the beginning of the period? Let's go back to the statement of financial position, and here we have the reserve, the item of bank opening balance at the beginning of the period. Remember when we discussed why we don't deal with bank during preparation of cash flows from operation? We said that bank actually is the total of all the statement. So it will be a later moment when we take into account the difference in bank, and this is that moment. So the opening balance for bank is 300. Let's put it here. Actually, I'm using formulas again, so when you have this Excel spreadsheet, you may work the same. What is the cash bank at the end of the period? What is the cash reserve or the cash balance? Now, if we go at the statement of financial position over here, we see that the bank is on the liability side, and we explained that actually the company had an overdraft, has a minus balance in its current account in the banks. And that means that, of course, I should take into account this balance, but with a minus. That means we have minus 200, not $200,000. Now, from 300 at the beginning, we are going to minus 200. What is the difference from beginning to the end? From plus 300, we are going to minus 200. What is the difference? Actually, the difference really is reconciled with a net change of cash flows. And when we see that, we are sure that we have not made any mistake, okay? Just in case, just assume that you calculate the net change of cash flows 650. When you check the difference in the balance of cash or bank or cash equivalents from beginning to the end, and you see that they don't match, they don't reconcile, you have made a mistake. Check your calculations again. Most probably, the most common mistake is a minus or a plus sign that you may have missed. Try to make those corrections. So usually you have a way, dear students, you have a way to check yourself. Have you been accurate or not? Or do you need to change anything? Okay? So this was the indirect method. With the direct method over here, things should be easier, I promise. But we have a break first and then we continue. 5 minutes break. Participant here in class, and thank you to her, she brought to my attention something. It's a minor detail, but maybe you need some more clarification about that online and here in class as well. Now, some of the participants are asking, how do we compare this net change of cash flows over here? This is the sum of the cash flows from operations plus cash flows from investing plus cash flows from financing. And this is minus 500. Whereas when we consider cash or bank balance at the beginning and the end of the period, actually we are referring to the change in cash balance from the statement of financial position. So these balances are not from the cash flow statement. They are from the statement of financial position. So the change in cash from the statement of financial position is usually the difference between the end less the beginning. So the change is 500 with a minus. This is where you should be certain that the two correspond to each other. Actually, sometimes you can also add, I call it a check figure. The check figure is simply the difference between the net change in the cash flows from the cash flow statement and the change in cash balance from the statement of financial position. Whenever you prepare the cash flow statement, you should find this check figure 0. If you don't find it 0, something is wrong with your calculations, okay? So again, this is what maybe I call it the moment of truth. You can have some relief if you are correct, and maybe if you are not, you can recheck and double check your calculations. As we are here, I would like to proceed with the direct method. I'm sure that you right now will find it easier to understand the direct method. Usually the direct method is more time consuming to apply in real companies, in practice, but for the purposes of in-class illustration, it may be easier than the indirect method. You will find it that way. But still many companies, like 70 or 80% of them, they use the indirect method to report the cash flow statement. Now the IS7 allows companies to either report with the indirect method or with the direct method, but most companies use the indirect method, and not surprisingly, it is very easy in practice to follow the indirect method. Maybe you found it very complicated with pluses and minuses, but trust me, in practice it is very simple to apply, because basically it receives information that is readily available from previous two statements. I received information from the income statement and adjusted the profit figure. Then we received information from the statement of financial position, and we just arranged the things together to have the cash flow statement. Whereas the direct method, you may find it easy here, but in reality, it may be complicated. Now, in the indirect method and the direct method, not everything is different. Luckily, there are a lot of similarities. For example, the direct method also will have the same sections of the statement. The first section will be the cash flows from operations. The second section will be cash flows from investing. And the third section will be cash flow from financing. Again, I will need to find that the total sum of the three operating, investing, and financing, so the net change in cash, which is again the sum of CFO, that should be equal with the change in the cash or bank balance from the beginning to the end of the period. So you see the two methods have many similarities to each other. The statement layout or the statement format at the beginning is the same, it looks the same. Something else that really is very helpful, on the other hand, is that regarding the cash flows from investing and from financing, everything is exactly the same between two methods. So what really differs between them is only CFO, the cash flows from operations. That means that when I go from the indirect method to the direct method, very freely I can just copy the information about cash flows from investing. Why? Because it is the same transactions, the same cash inflows and outflows, and the same amount of the cash flows from investing, minus 4,250. Again, the two methods do not differ in everything. They have many similarities. So I started with these similarities just to make ourselves feel better that we do not have to redo everything from the beginning. That is, the cash flows from investing is the same. Also, the cash flows from financing is also the same. The same cash flows, inflows or outflows at the same amount. So I just copy the information over here. Okay, so this is the this is the representation of the last two sections. It is the same between both methods. Now, what I have to do is only work with the cash flows from operation. Yet another thing before we go on. The amount of the cash flows from operation is the same under the two methods. That means that when I calculate the CFO over here, it should be the same amount that I calculated under the indirect method, not another one. What changes in the direct method is only the way we calculate this amount. So again, cash flows from operation, the amount should be the same with two methods, but the way that we calculate that is the different. In the indirect method, I started from profit before taxes and adjusted the amount of profit before taxes. Actually, in the direct method, I do not start from the bottom of the income statement, but we start from the top of the income statement, and basically what we do is that we take the items one by one and we convert them in actual inflows and outflows. I'm repeating again. In the indirect method, that is why it is the name indirect method, we start from the bottom of the income statement and we adjust the profit. In the direct method, we start from the top, from the sales revenue, and we convert each of the items into actual cash inflows or cash outflows. Okay, so we will do the same right now together. We will take revenue and we will convert that in cash inflows from customers or cash receipts from customers. We'll take cost of goods sold and we'll convert that actually in cash that we have paid to our suppliers. We will take distribution costs and we will convert that in distribution costs that we have actually paid to whatever our suppliers are, and so on. So you see the way of making the calculations in the direct method. This is why it takes a lot of time in practice. We start one by one and we take each item and convert into actual cash flows, cash receipts or cash payments. How we do that? Simply by applying the same rules that we have already mentioned in the indirect method, so it should not be difficult. We start with the first line, which is cash receipts from customers. Again, what is cash receipts from customers? Simply, it is this revenue from sales that I have here. How much of that did we actually receive? How can we calculate that? We we have generated revenue to our customers, 45,900, but how much did I actually receive from this amount? How can I calculate that? Now remember that revenue is connected with the trade receivables in the statement of financial position. You see the trade receivables over here? They represent what money I am expecting to collect from my customers. At the beginning of the period, they owed to our company 3,400. By the end of the period, they owe 3,000. That means that, what did we say before in the indirect method? That means that they have paid 400 from their accumulated liability towards us. Do you get the situation? So these customers have reduced their liability to us by 400. This means that we have collected this money. And except for 400, we also collected the revenue for the period, 45,900. That means that the revenue over here, it will be equal with 45,900 plus 400, the reduction in the, let's say, liability of the customers towards our company. This is 45,300. Of course, this is something that we need to clarify and to have a formula to apply all the time. The formula that I usually suggest is revenue plus opening balance of trade receivable less closing balance trade receivables. This is the formula that we may apply all the time, and I'm just writing it here. Calculating this amount, 45,300, we can follow very easily with formulas in Excel, following the formula that I wrote here. And I'm just doing it now, so you can have the Excel spreadsheet and use it for yourselves later. So cash receipts from customers basically are the revenue from the income statement, the first line, the first item in the income statement, plus the opening balance of the trade receivables in the statement of financial position, you see over here, less the closing balance of trade receivables in the statement of financial position. Even with applying the formula, we find the same amount. Now, you see this formula, it is the same, allow me for one moment, it is the same of the one that we mentioned over here at the indirect method. Remember we said that for interest, for taxes, for everything, you use the same formula. What is the amount of the period plus the beginning amount less the closing amount? And that should give you a cash flow, okay? So in case you are not decided what to do, consider that to convert an expense or income into a cash outflow or cash inflow, you can combine the lines and items from income statement with those opening and closing balances from the statement of financial position. Basically, it is the same thing. The line from the income statement plus opening balance less closing balance. We see here for the interest the same thing, for the taxes the same thing, and even here for the revenues and collections of money from customers, it is the same formula. Okay, is that clear for just to follow this model for almost everything? Almost, there is only one exception that I will explain. So this is cash receipts from customers. What did I do? By applying this formula, we converted revenue, which is an accrual basis measure, into cash inflows, cash receipts, which is a cash basis measure. So what basically the direct method does is that by applying some simple formula with logical meaning, they convert the accrual basis accounting into the cash basis accounting, okay? Questions so far? That's easy. Now expect the second one, it should be a little bit more complicated. The second line over here, it is the cost of goods sold, and as we said, it is complicated because cost of sales includes direct material, direct labor, overheads, fixed and variable, and so many things over there that I should be very careful how to calculate actually related to cost of sales. How much did I pay to my suppliers? In the direct method, the second line is cash paid to suppliers. And not only to suppliers, but cash paid for everything that relates to the manufacturing of finished goods. So how we calculate cash paid to suppliers? This is a long formula that maybe we do not have time to explain logically why plus and minus. For the moment, I would require you to memorize or write it down. I would allow you to have that in the exam. But if you want to know why, just ask me later. So again, it's a long formula. We don't have time to go into details why plus and minus, just have it written somewhere for the sake of the exam. I will allow that. If you want to know why, ask me later and I'm happy to explain. Regarding cash paid to suppliers, we start with the cost of goods sold from the income statement. We add closing balance of inventory and we deduct opening balance of inventory. What I have written inside the brackets of this line over there represents only the purchases of the raw material. So what we have been calculating with the first part of the formula is only the purchases of raw material. But I need to calculate how much did I pay, not how much did I purchase. Because maybe some part of the purchases I did not actually pay out. So I continue outside of the brackets by adding the opening balance of trade payables and deducting the closing balance of trade payables. And by this, what we did is that we calculated the amount of payments only related to raw materials. But remember, we have other items like salaries. Okay, that maybe it's included in there, but remember that we have some non-cash items over here included in the cost of sales. Remember that we have 1, depreciation, and 2, loss of sale of fixed asset. These both are not monetary expenses. That means that I have not paid for them. And in this moment, I have to deduct these 2 items that I mentioned. So maybe you want to write the formula in a summarized way, less adjustment for non-monetary expenses. And what we mean by that, can I write in the brackets what we mean by non-adjustment? For non-monetary expenses, because it may differ from one company to the other. For our company, the adjustments for non-monetary expenses are depreciation and loss of sale of fixed assets, but it may be different items for other companies. So for our company, it means depreciation, okay. Now, you see why I allowed you not to memorize and think over this formula? Just apply that because it's too long. And sometimes when you see it carefully, you may think that, oh, maybe, why do we do that? We add the closing balance of inventory and we deduct the opening balance for inventory. But regarding the trade payables, we add the opening balance and we deduct the closing one. Again, it all has a meaning. Whoever wants to know, I will be happy to explain. I just don't want you to overthink about this stuff over here. It's a formula, just apply that, okay? And what we mean by adjustments for non-monetary expenditure, please be careful that this may be different for different companies. So this is why we are mentioning the exact stuff for our case. Again, if we apply this formula, we should be able to convert the cost of goods sold from the income statement adjustments with the balances, opening and close balances from the statement of financial position, we can be able to apply or to calculate the cash inflow. In this case, it is a cash outflow because it's a payment. Any questions so far? Can we apply the formula right now? What do you think? Yes?
The for value change?
Sorry?
You have to count the for value change too.
The fair value?
Change. The 700 that we recorded in the CFO in the time direct method.
This one over here. You mean?
Yeah.
Okay.
Why do you not count the little?
That's a good question, and thank you for asking. Whenever I tend to skip things and work fast, you just remind me with very good questions. Do we need to include this 700 over there?
No monetary.
Whoever answers, I want an explanation. Do we need to include the change in fair value for investment property in this line over here? A very good explanation. Gloria.
No,
No
because
monetary.
it is not comprising cost. Cost of sale, cost of goods sale.
Okay? A slightly better explanation that would not require me to repeat it after you.
Because it's direct method, so we
Uh-huh.
don't go from the back, so we just add what it is cash from now. So
Okay.
that's not cash.
Okay, both of you are complementing the answers for each other. Do you, the other participants, do you get the meaning, or do you get why we do not need to take into account the fair value changes? Why it's not necessary to account for them now? Remember what I said, we,
No monetary.
at the direct method, both girls said that. At the direct method, we are not starting from profit before taxes. We are not adjusting for the non-monetary items included in profit before taxes. We are taking the items in the income statement one by one. That means that when I make the adjustments, I will focus only to those adjustments that are included in that specific line over there. So what is included in revenue? It is the revenue and then the opening and closing balance of the trade receivables. Done with that. Continue with the other. What includes cost of sales? Well, this includes the purchases, the open and close balance of inventory and trade payables, and also all the other operating expenditure that are not monetary. But this, what we mentioned, depreciation and loss on sale, we previously emphasized that are part of cost of goods sold, whereas the rent fair, the fair value changes over here is below that. I will take that into consideration when its time comes. Remember, we are going here step by step. We started with revenue, now we are dealing with cost of sales, then we are going to gross profit, then to distribution cost, and so on. This is a direct method. So it will come the time when we discuss the fair value changes. Again, the direct method, the best thing of that is that you don't have to take into account many things immediately. That makes or causes the confusion with the indirect method. Because I start in indirect method with the profit before taxes, I need to account for many things at once, and this, it's okay, makes us confused sometimes. Whereas direct method is easier and slower. Take each line one by one and consider only the effects included in that item, okay? The only item that is a little bit complicated in the direct method is this one, cash paid to suppliers. It has a long formula. But other than that, the rest should be pretty easy, okay? So if we calculate the cash paid to suppliers, if we start now, I should start with the cost of goods sold over here. We should add, going to the statement of financial position, we should add the closing balance of inventory and deduct the opening balance. Inventory is special. We do not add the opening balance and deduct the closing one like the other items. Why is that so? Because that would cause a very long discussion, so I'm just leaving that out. Whoever wants to know, ask me later. And then we add the closing value, opening value of trade payables, and deduct the closing value of this amount. Again, don't forget to deduct the amount of depreciation. Please, who can remind me what the depreciation is? 100 and?
Fine.
I don't want to ruin the formula over here. How much was the depreciation? 1,000?
300.
Okay, less 1,500 less the loss. I remember it was 500, right? Okay, so this is the, I should check the formula again. Okay, so this is, because we have it with a minus in the income statement, I should be careful with the minuses in the formula, but again, the cash paid to suppliers is 28,200 with a minus because it is a cash outflow. Any questions so far? You should be able that if you have this Excel spreadsheet that we'll share later, you can do and solve whatever exercise you have in the textbook. A couple of them I have also included for the tutorial this afternoon. I don't know if we will have time to go over that, but we will have, of course, we will plan some more time. We'll not leave anything without covering and explaining until you understand everything really very well. Okay, so we accounted for revenue. We converted the revenue to collections from customers. We accounted for cost of sales. We converted cost of sales to cash paid to suppliers, right? Now, I'm not continuing with gross profit. Why? Because gross profit is simply the difference between both of them. I'm continuing with the distribution costs, and I'm trying to convert these costs into actual payments. And what I write over here is distribution cost, and I'm adding this word paid. This would become more clearer like this. I'm not just thinking, or I'm not just accounting for distribution costs, but I'm taking into consideration the part of those costs that are really paid. Now, how can I be sure I'm doing the same question as before? The distribution costs are actually 2,400. Did I pay them all, or I paid more, or did I pay less than that? How can I check and be sure about this fact? Again, I'm asking you, right now you should have developed like investigative features. How can I be sure that I actually paid 2,400 and maybe I paid more or I paid less? Where do I check for that? How do I make sure I paid exactly 2,400 and I say I paid exactly this amount, no more, neither less? How am I sure about that? Is there a way to check and to be confident that that's the right answer?
On this variable.
Good. We go with the statement of financial position. If you have any doubts, go and check for yourself. Check the current assets and current liabilities. Do you have any item over there that says probably distribution costs payable? We don't have any of that, okay? We don't have any part of the distribution costs that have been left not paid and is payable. That would mean that I paid less, okay? So check in the balance sheet. Also check the current assets. Do you have any part that says distribution costs prepaid? If you have prepaid distribution costs for other periods, yes, you could have paid more. But if you check the current assets and current liabilities and you find none of these items, you are sure that what was the expenditure of the period, you fully paid for that, you didn't pay anything in advance or prepaid anything for the other periods, you didn't pay any accumulated deferred liability from previous periods, okay? So it's exactly the amount that you find in the income statement. The next item, administrative expenses. And I'm writing over here administrative expenses actually paid. You see that we add this small word at the end, paid. What did we pay from the administrative expenditure? Again, we check the situation. The administrative expenditure are 7,850. Did I pay this amount, or maybe I paid more because I'm prepaying for future, or maybe I pay more or less, who knows? To be sure about that, what do? Again, we go at the statement of financial position, we check current assets and current liabilities. Do we have any item that says administrative costs prepaid for the future? Or part of current liabilities, I would find like administrative costs payable. That means that I did not pay that now, I will pay for the future. Do you get what I'm saying? So when you convert an item in the income statement into an item in the cash flow statement with the direct method, you always follow these formulas over here. You take the item from the income statement and you adjust that with the opening balance and closing balances. That in case you don't have these balances, it's very simple. It is exactly the amount of the expenditure that you find there, okay? Any questions so far? So again, administrative expenses paid is the exact amount that I find in the income statement. Why? Because I have not prepaid anything, I have nothing payable, so there is nothing that I can write as a formula and adjust for from the statement of financial position. This is why it is pretty simple. Let's continue. After the administrative expenses, we come at these two lines over here. Good. Investment properties. They have rentals received and fair value changes. Should we put something out of this into the cash flow statement? What do you think, and why not?
No, because it's not monetary, so.
Okay, first, rentals received I should not include here. Why? Because their part, the rentals received 350,000. They are not part of cash flows from operations. Remember, they are over here. So I should not include them in two different sections. First. Second, if we discuss about the fair value changes, okay, it should not be included because it's not monetary. It's something that is not actually realized. So just skip through them both without feeling guilty that you have forgotten something. We come at interest expenditure. This should be a repetition of what we did in the indirect method. We have interest expenditure of 600, but how much interest actually did we pay? So direct method over here. Interest payments. Who remembers the formula? I'm going to write it here, of course. The interest payments are interest expenses plus interest payable at the beginning less interest payable at the end of the period or the closing balance. You see, again and again, we repeat the same formulas, okay? The item from the income statement plus the opening balance less the closing balance from the statement of financial position, they should do it. Now let's calculate the interest payments. Interest expenditures are 600 plus the opening balance of accrued costs less closing balance. Oh, we have a different figure over here for interest payments. Remember, indirect method gave us 550,000 and the direct method is giving us this amount. Any mistake that I'm probably doing over here? There is a mistake and I did that on purpose so you can find that. So which is my mistake over here? Or you are too tired to find that?
It's minus interest.
It's always the minuses. Every time that we may make some mistakes, it's the minuses. Okay. Why do we have these two minuses over here? Class, why is that necessary? Remember that the amount of the interest expenses is represented with a minus here. So following the Excel rules, we have to reverse that by adding a minus, and so we can make the calculations with positive amounts from the statement of financial position. Simply a technical thing. Okay, let's continue with taxes. Taxes paid. So the next item, it is interest expenses. We are not really dealing with profits, no result. We skip the gross profit. We also skip the profit before taxes. We just deal with revenue and expenditure of it, okay? Because they are cash inflows and cash outflows, obviously. So we follow the law and the rules, and we come at the tax expenditure, and we try to convert the tax expenditure into taxes paid. Again, the formula is the same. You should have become familiar with that formula right now. We start with taxes expenses. Okay, what we have? Opening balance taxes payable. We deduct closing balance taxes payable. Now this should be something that maybe it is easier to memorize. The same formula applied for different items. Then how is the taxes paid calculated? Remember the minuses because of the technical rules of Excel. So we start with the income tax over here. We add the current tax payable at the beginning, and we deduct the closing amount. And we have the taxes paid 1,950. Double check with the indirect method. It should be the same basically. Okay? And now, okay, we have the moment of truth again. Calculating the cash flow from operations. So the sum of all these items over here, it should be equal with the one that I already calculated in the indirect method. So I'm making the check here, for example, cash inflow minus all the cash outflows represented for suppliers, distribution costs, administrative, interest, and taxes. And yes, we find that the cash flow from operations from direct method is the same as that from indirect method, and the rest of the cash flow statement basically is the same under both methods. Now you see that both methods actually have more similarities than differences. The only difference they have is the way of calculating cash flows from operation. The indirect method starts from the gross profit and makes all the necessary adjustments, whereas the direct method, it starts from the top of the income statement, taking the items one by one, applying formula to convert them into actual cash flows, okay? The rest is the same. The amount of the cash flows, operating, investing, and financing, the sum of them is the same, and in both methods, the sum of the cash flows should be equal with the difference in the cash balance from opening to the close of the period. Now let's check that. How much is the change, net change in cash in the direct method? Actually, it should be the same, no difference, but just to complete what we are doing. Okay, so it is minus 500, the difference. I'm also copying the same thing that we did actually with the indirect method because it makes it easier for us to understand. The cash balance at the beginning, we simply take that with the formula from the statement of financial position. Here is the bank at the beginning, And here we have the bank situation at the end of the period. Remember, it's on the liability side. That's why we put a minus. You should find the check figure here, 0. If it is 0, this means there's no mistake. Over there, all the figures, they match each other, they are reconciled, and this is what we want from the cash flow statement. Okay? So, well done. We made it through the end of one very long but a common exercise for this chapter. You will see for yourself that what you are required to learn and to know from this chapter is actually how to prepare a cash flow statement. We did it for one company, and maybe in the tutorial we will have the possibility to also see other exercises. Now, if you allow, I will jump to the, we have some minutes left. We will jump to the presentation in PowerPoint. Where did we leave everything? And we will reinforce theoretically what we said. We will reinforce again theoretically what we said and explained through Excel, okay? What we are trying to do for the remaining minutes, thank you for the patience. I know it has been not a very easy morning to have everything processing for something that it is complex, it's not easy, I recognize that, and well done. So we are completing the presentation of this chapter by summarizing theoretically what we saw in practice through preparing an actual statement of cash flows. So you see that this statement is organized in 3 sections. Cash flows from operating activities, you can either use the direct method or the indirect method for preparing this section. Both of the methods have their own peculiarities, and we explained how we start the job, what adjustments do we do, what formulas do we need, and so on. Whereas for the other 2 sections, things are really very easy. For first reason, there are very limited transactions included in there, because these transactions do not happen daily. They are limited in number, so it's easier for me to process that information. And the second thing is that you can only use one method for preparing these sections. There is no direct, indirect there. You just have to follow the direct method. How much money did you pay for purchasing property? How much money did you get from selling existing machinery, and so on. There is no indirect method and adjustments that you need to memorize, okay, and to apply. So this is a summarization of the rules how to prepare the cash flow statement. Now again, the direct method is based on actual cash receipts and cash payments. Can I help you? Maybe I can help. Please try to ask also if you need to clarify something. You are welcome to ask. So what I was saying is that the direct method, again, is based on cash receipts and cash payments. The information can be obtained in 2 different ways in the direct method. From the analytical accounting records of the entity. This is if you really work in a company and you are prepared to you are asked to prepare the cash flow statement under direct method. Of course, you are going through the accounting records, general ledger accounts and journals, and that becomes really tiresome and a very long process. Nobody wants to go through that. The second way is by adjusting sales, cost of sales and other items for changes during the period in the inventories and operating receivables and payables and other non-cash items. Basically what we did, through going through the direct method, we presented some formulas, and we basically said, take the item from the income statement and adjust with opening and closing balances, in case they are, from the statement of financial position. Some of them had balances, for example, interest and taxes, but some of them didn't, distribution costs and administrative costs. It was really easy because there were no opening or closing balances from the statement of financial position. Actually, the direct method usually proves to be time-consuming and costly in practice, not to us. I bet that for us it was easier than the indirect method, but trust me, in practice it becomes really very difficult to apply. I'm mentioning only two problems that may arise. For example, when we convert revenue to cash collections, remember that revenue does not include the amount of sales tax, the value-added tax. But instead, the trade receivables amount, it includes the value-added tax. So when you adjust figures, you have to keep in mind that revenue is without VAT, whereas trade receivables, they have VAT included. But still, value-added tax has several percentages according to various types of inventory. So this becomes very, very complicated to handle. Only the VAT, value-added tax. Add to that the problem, another yet common problem, is the currency issue. You have customers all over the world, and you deal with them not only in euro, but in dollar, or yen, or some other currency. How do you deal with the currency, with the differences? So this becomes really complicated in the direct method. It's not as easy as we represent it. And that is why most of the companies, they use the indirect method. You may find the indirect method really very complicated, adjustments, pluses and minuses, but actually in practice it's really very easy. You don't have to think about value-added taxes or the currency conversion rates, differences and so on. So this is the direct method. This is like a comparison between the line items from statement of performance and how we call them in cash flow statement. You saw that sales revenue were converted to cash received from customers. Cost of goods sold was converted to cash paid to suppliers. Gross profit, nothing to do with that, we said. Why? Distribution expenses was converted to distribution expenses paid, and so on with interest and taxes. So it's enough to add this word paid at the end of the item, and so you have converted that into a cash outflow, actually. The direct method formulas, the same that we represented in Excel, you may also find in the PowerPoint slides. They are basically the same, so I'm not stopping to discuss that. And we have here some test questions. I don't know, maybe we can have some, we have some minutes to take them. Entity B has reported sales revenue, purchases, increases in trade payables, and many other information that it doesn't really need to take into consideration. We just need to calculate how much taxes did the company pay. In order to calculate the taxes paid, remember, I need to apply this formula. Tax expenses plus taxes payable at the beginning of the period, less taxes payable at the end of the period. This was the formula that we represented and could use to calculate the taxes. So we have the income tax expenses and we have the increase in taxes payable. How much taxes did you think company is paying? Remember, each one of these questions has been a test question in the exam. That means that in the exam, probably you are not going to be asked to prepare a full statement of cash flows, but you are going to be asked to calculate items to include in the cash flow statement. And that is one of the items. How much taxes did we pay?
4,000.
4,000, yes. We also have the same answer in the chat, and I agree. Why 4,000? The income tax expense was 5,000, so I need to pay 5,000 for the current period, but we see an increase in our taxes payable. That means that we have paid less than 5,000. 1,000 less than 5,000 means that we have paid only 4,000 taxes. And you have also the explanation over here. Income taxes expenses less increase in payables. That is the amount of taxes paid. Good. Okay, another one. basically the same data, but another question. How much did we receive from customers? Okay, receipt from customers relate to revenue. Here you have the revenue, 50,000, and trade receivables. Oh, we have decrease of trade receivables, 3,000. How much money did we actually get collected from our customers?
53,000.
Okay, that was easy because there is not an option with a minus. 53,000, why, Gloria?
Because we had revenues, the decrease of trade receivables.
So we are collecting all the revenues, but also we are collecting this 3,000 that is a decrease in trade payables. Now, what does that represent? A decrease in invoices to be paid from customers to us. That means that we have not just let them take the money. We receive the money from them, okay? So 53. Yeah. Okay, so again the same data, but another question. Sales revenue, how much did company pay to its suppliers? Now, the payment to suppliers are linking some more items. Are linking purchases. Oh, okay, it's simple. We are not having cost of goods sold here. So purchases and trade payables. How much did we pay?
27.
Okay, do you all agree with that? Good, I'm happy that we made it. So the direct method is more intuitive and I'm happy that you understand. Of course, after the direct method, we have the indirect method, but this morning we went through the slides, if you remember, so I'm not stopping right now. I mentioned this morning the slides. We have also some test questions. I think you have this in your slides, yes? If you have them, I'm just skipping. Okay, do you have test question 14 as well? Solved?
Yes.
Do you have the solution? Okay, if you have the solution, I'm just skipping for them. They are easy. Trust me, it's just the application of those formulas that we represented. Revenue plus opening balance plus closing balance and so on. Okay. Something that I wanted, this is why I was just hurrying because I wanted to mention this. This is the statement of cash flows from Pusal Group. This is one of the financial statements that Professor Buso was sharing with you constantly and analyzing. Now, one thing is to know how to prepare the cash flow statement. This is one of the learning objectives. But the other thing is to know how to read the information in the cash flow statement, okay? So, I have presented here the cash flow statement of this group, PCA group, which is the method that we are using. This is just the first part. Sorry, this is only the cash flows from operations. The continuing cash flows from investing and financing, it's over here. Okay? Which is the method that this company is following to prepare the cash flow statement, direct or indirect method? Where do we understand that?
Because the second column is the consolidated profit and then
Okay, this is a group, so we have to do with consolidated amounts. So we start from profit and loss, and you see we make adjustments over here, okay? And then we arrive at cash flows from investing. You see the adjustments are basically the same: depreciation, provisions, gains or losses on disposals, and so on, okay? Whereas the rest of the cash flow statement is following the same rules. Now, being this not a simple company but a consolidated financial statement, you have many items in the investing and financing sections because you have a lot of movement in subsidiaries. You see acquisition of consolidated subsidiaries and so on. So because you have to deal with subsidiaries as well, and not only with property, plant, and equipment, the sections of investing and financing are slightly more complicated. But still you have as notes As the notes of financial statements, which are to be found at different pages, you have the clarification of every single number that is calculated there. For example, what I'm trying to explain here is you see here investment in property, plant and equipment. Over here, investments in property, plant and equipment. This means purchases of property, plant and equipment. In other words, for year 2020, I think, or 2019, doesn't matter, the investment in property is 2,765, is with a minus to represent it's a cash outflow. Now, where do we find the explanation and details? Where in the note 9.2b. And this note was also referred to in the columns of references. You see here? That means that if you want to read more about the purchases, go to this note, find that some pages later, or some tens of pages later, and you will find this clarification. Oh, and you see, during 2019, the purchases or additions are 2,765. So the same figure, the same amount. Remember, you will have the test for the last year. I will upload on Moodle, not now, but later, close to the exam, not to make you overthink right now. You will see that regarding the cash flow statement questions, you are required not only to be able to prepare and calculate items, but also to read. You will have excerpts or parts of the financial statements, and you will be required to say how much you spend purchasing or how much money did we get from selling something, okay? So this is why it is important to be able to understand where the different items are. The last slide that you have there are some examples with the cash flow statements. Now, these are different exercises, not the one that we solved together. The exercise that we solved yesterday and today, it's exercise number 13, if I'm not wrong. And the textbook that you have, at the end of the chapter, there are many exercises to be solved. Number 13 from them is the one that we solved this morning together, okay? Whereas these exercises over here, the solution of these exercises is included in the textbook. So if you want to go through all the details, you have them there. In case you don't understand anything or something related to these examples that are included in the textbook, please let me know. You all have the textbook, electronic textbook, right? So you will find all the solutions of these examples. And also, as I said, the exercise that we solved together was number 13. Now, what to include in the group work presentation regarding the cash flow, this is a very large slide. You have to analyze the cash flow statement. You have to state the method that has been chosen by the company to represent and prepare the cash flow statement. And then you have to check in the notes whether the company, if they have followed the indirect method, the IS-7 standard requires companies to provide a reconciliation from indirect method to the direct method. Hey, I'm not finished. 1 more minute, please. This is important. In case you don't have this in your work group, then you will miss some points. IS-7 says you can choose between indirect and direct method, but in case you choose to prepare the statement with the indirect method, in the notes you have to provide a reconciliation between indirect and direct method. That means that actually you have to follow both methods to prepare the financial statements. One of them you will include in the face of the financial statement themselves, and the other one will be included in the notes. Check for your companies, have they done that? So have they fulfilled this requirement of the standard or not? And be prepared to understand the reconciliations between both methods. During the tutorial, we are going for ourselves to see a case, an illustrated example, how to convert from indirect to direct. It is not easy, but we are going to do that. And then we have to prepare, you have to prepare a short summary of main things that you observe in the cash flow statement. For example, there are too many payments of dividends, too high dividends, or too many payments for taxes, and so on. So through your analysis, you can understand better the dynamics of cash inflows and cash outflows, okay? Well done for today. We made it till the end of the cash flow statement presentation chapter. This afternoon we'll continue with the cash flow statement with the tutorial exercises, okay? See you later.